Happy November. Been getting a lot of client questions recently about everything going on, whether that's geopolitical with Ukraine continuing and now the conflict in the Middle East. Maybe it's economic data, what's happening is a recession on the horizon, things like that. And so I figured this month, rather than writing a blog post, wanted to record this short video just to kind of address some things and why, at least from our perspective, we want to remain invested and invest in stocks and maybe even increase allocations a little bit as we head into the end of this year and into 2024. So I want to share a couple charts and just kind of talk through, remind everybody that every year we have the same issue. Every single year there's something that comes out that is concerning. There are news headlines that make us all worried about where's the stock market going to go. And so I want to start just in the short term, looking at the last couple of years. And what I'm going to show you here is the performance of the S&P 500, and then all the things that are what are called tail risks, or things that mutual fund managers have been worried about at that same time. And as you will see, maybe some of these will remind you of things you've been worried about in the past. But as you see up here on the screen, we have the yellow line is the S&P 500. This is the actual performance, what's actually made money over time. And you can see that it continues up and to the right. This is from 2011 to now. And each of these bars are the main concern that people had. And so you had the EU sovereign debt funding and concerns about Greece and Ireland, Iceland, a lot of issues. The word contagion, I think, was talked a lot, that we're going to have this major crisis in Europe. Well, we survived that and moved forward. Then we had the U.S. fiscal cliff. I remember that was a huge discussion 2013, and that we'd have this cliff and basically the economy would go into a depression. Obviously, that didn't happen. Then you had a few different times here. You had the China hard landing, that coming out of the recession. With the saying has always been said that we can't trust China on their economic data. They were making high single-digit returns every single year like clockwork, with almost no variability. That's just not the way economics work. And so we were concerned globally about this hard landing. That didn't happen, continued forward. Then you have various geopolitical crises. Then you had the Trump election and worries about the EU disintegrating. And then, okay, what about the Fed policy in 2018? What about U.S.-China trade war in 2019? Then we had another presidential election, and obviously in the news that was all contentious and everything. And then we had coronavirus. And now for basically since mid-2021, it's been all about inflation and the fact that central banks are raising rates, and we have what's called the hawkish central banks. Through all of these things, the markets continue to go up. Now, obviously, last year, things were down. Stocks were down, bonds were down. And in the last 3 months, that's also been challenging to be invested. But this isn't just something that's happened the last 12 years. I've got another chart for you here, and that is looking all the way back to 1929. And you can see Wall Street crash, Great Depression, World War II, Korean War, Cuban Missile Crisis, Chernobyl disaster, the Asian financial crisis, dot-com bust. Through all of this time, the S&P 500 continues to go up. And there's always things to be concerned about. There are always going to be news that's going to scare you, but the history of the markets, the history of the economy, as companies innovate, as we all try to better our own lives, markets continue to go up. And that is the most important thing that we can keep in mind as we are investing, looking ahead the rest of this year and then going into 2024, is most years we expect this stock market to be up, and a little over a quarter of the time we expect it to be down. And that's just part of investing. But if you have a longer term view, similar to what's here on this page, we would expect that you're going to still have positive returns. And I'm going to leave you with one more thing. Although we're not market timers, we're not trying to predict where things are going, there are some trends that are in the back of my mind, and I think we need to keep in mind as we look ahead. So we are in the year before the presidential election, and historically, starting November of where we are right now, November, the year before the election, all the way until April, is historically the best stock market performance of a 4-year election cycle. Add to that the fact that if you, going all the way back to 1950, if you bought the Dow Jones on November 1st, held it through the end of April, sold everything, you would have earned all of the money that the Dow Jones ever made. Another way to say that is from the end of April through the beginning of November, the Dow Jones historically has not made any money. It's been zero. It's been flat. And we are just coming off a time. That's just part of the way that the cycles work. We're not trading around it, but we're keeping it in mind. So we look at the last couple months, and it's been challenging. And markets have not performed the way that anyone would like. The stock market's down for 3 months in a row. That's normal. That's normally what happens. Again, we're not selling out at the end of April, but I'm not worried about it. And as we look ahead, there's a lot of things in the news to be concerned about, and yet we want to keep being invested and maybe even add some more to stocks. And so as you look for the rest of this year, just keep that in mind. As you see the news articles, feel free to reach out. Happy to talk about what this means for the portfolio, for anything that you see. But at the end of the day, we're going to keep investing, and we expect the markets to be up over time. So let us know if you have any questions. Take care.